let's take the discussion forward with Pramod Gubbi of Marcellus also joining us on the show today. Pramod, afternoon. Thank you so much for your time. Pramod, I'd like to talk to you about a space which is flaring up, and the numbers actually Q2 updates, caught the attention. Be it Poonawalla Finance, 150% higher YOY. Today, Ugro came out. Five-star business also recently hiked their guidance. One is getting a sense that, after GST is now becoming a norm and this Jandhan, Aadhaar, mobile phone, it appears that small ticket loans, be it enterprises, SMEs or even individuals, is going deeper into the country. And it's like a sachetization which used to happen, which happened in consumer space few years back. The 2 rupee shampoo, 5 rupee biscuit packet. Or do you think, are you witnessing this as a risk also? Because in this business, collection is a bigger issue, not giving loans.
Right. No, thank you. It's great to be here again. No, great question. I think a lot of people are scratching their heads around this. This is perhaps the most aggressive retail credit boom that we've seen in the country for a long time. We speak to people on the ground, distributors of loans, and clearly everybody is surprised by the strength of demand for retail loans. Now, I think there are a few structural drivers which are driving sustained credit penetration in consumer. One is, like you mentioned, with access to data, lenders are better able to assess the risk of the borrower. Also, I think there's also structural change in terms of culturally. Indians are becoming more and more open to borrow, even for consumptions. People are talking about borrowing for holidays and travel and weddings and so on, which hitherto wasn't the case, or at least wasn't as broad-based. So there are some structural drivers which can explain this increase, but there's also a cyclical driver, and that's where the risk is. You mentioned, of course, lending is a classic cyclical sector. To some extent, we've had a significant period of cleanup amongst the lenders, whether be it banks or NBFCs. That cleanup has meant that banks are now sitting on significant equity, which can help them drive the supply side of this credit boom, which will in turn at some stage result in excesses and a reversal, both in terms of higher NPAs as well as pullback in terms of retail credit growth. The question is, are we there in terms of the excesses already? Are we headed in that direction? What we hear from on the ground is there's not much stress. Of course, there are pockets where there is stress, but most people on the ground don't see, in terms of the repayments coming through, they don't see a significant reason to worry. But at some stage, I guess, like always, the credit cycles will peak out, either because there is an event in the economy, or lenders have gone overboard in terms of lending. But at this stage, I think it looks like a Goldilocks situation where demand is pretty strong, asset quality concerns are not that grave. So therefore, I think we should continue to see this sort of growth in retail credit.
Since we are talking about retail credit, let's listen in to the management of Ugro Capital as well, because they have managed to report a very strong set of numbers for their Q2 provisional updates. But as Pramod pointed out, the question is it going to be A, sustainable, and B, what happens to collection and asset quality? Let's listen in what the reply was.
We started April at 500 crore monthly run rate. We exited at 6,000 odd crore. You add our 6,000 to 7,000 crore of disbursement, and that's why we should be between 9,000 to 10,000 crore this year. Our natural progression would take us to around 700 crore of March exit run rate in March 24, and now we're adding a little bit more infrastructure. So we're adding around 75 physical location. We're entering 2 new states, which is UP, 3 new states, UP, MP, and Andhra. And hopefully by first quarter, this run rate should increase to around 900 to 1,000 odd crore. So theoretically, we should be at around 18 to 19 to 20,000 odd crore by end of next year. We want to maintain the blend of 70% of secured asset and 30% of what we call the business loan. But I must remind you that all of our business loan, a majority of that are also guaranteed by CGT MSME. So 75% of our unsecured loan are guaranteed by the Credit Guarantee Trust. So to some extent, they are also quasi-secured. Within that band of 70% secured, we have secured by property as collateral, we have secured by machinery as collateral, we have micro enterprises, micro secured loan, we have supply chain finances, where then some sort of support from the anchors. And then we have what we call the channel, which is our Grow Extreme platform, where we have 75 plus partner, wherein there is some form of credit enhancement coming from the partner.
So take a look at what's happening within the IT pack, and Anisha just flagged off. While there is, rumor or buzz that Wipro could announce a buyback, but that's not a possibility, like she just highlighted, given that they've already done that this year too. So 3.5% higher nonetheless for Wipro. But today, the rest of the IT pack, led by TCS, is a little bit in a slumber mode. You're not really seeing any deep gashes, but both yesterday and today, ahead of the numbers post-market hours for TCS, that's a little bit lackluster. Similar is the picture for an HCL Technologies, or for that matter, even for an Infi. Pramod, what's the expectation from IT? I mean, we all know it's going to be a muted quarter. Is all the excitement now only around buybacks? Is that what's going to keep the street warm on these stocks?
Yeah, no, I think short term there are demand concerns. There was a little bit of a full, recovery over the last few months, with the expectation that interest rates have peaked out, and hence the banking system is all right, particularly in the West and in the US. Banks are a big customer of the Indian IT service industry, and hence has the importance. But over the last month or so, what we've heard is, the market is looking at continued hike in interest rates, which could hurt the banking sector, and in turn continue the slowdown in growth that we're seeing for IT services. The short-term concerns remain, and therefore, the excitement could be from buyback. But I do think that the longer-term prospects remain attractive for Indian IT services. If technology becomes a ubiquitous part of our lives, it is hard to see how Indian IT services, or any technology provider for that matter, will have less to contribute to that. So to the extent that valuations have sort of corrected, given the stocks haven't gone anywhere in a couple of years, barring the last quarter recovery, do think for long-term investors the sector provides a fairly attractive entry point. But I do acknowledge short-term concerns remain in terms of growth.
Pramod, how would you approach the entire two-wheeler pack? There's a big upgrade coming in today in TVS Motors, saying that their exports game is improving a whole lot. Hero Moto too, on the other hand, is upping its game as far as the premium end of their bike offering is concerned. And then there are concerns on competitiveness, or whether Eicher would be able to face this competition. Which part would interest you?
No, I think clearly you can see from the actions of the players themselves, there's clearly premiumization happening. Whether you call it the K-shaped recovery of the economy, or driving inequality in incomes and wealth, it is at the higher end of the two-wheeler range, which clearly has more structural demand drivers. Yes, it is also reflected in the fact that there is more competition coming into that space. It is clearly it is the fact that structurally demand is strong, which is attracting that competition. Having said that, I think we do have a positive view on iShare. We do own it in our portfolios for our clients as for ourselves. We believe over the years, iShare has sort of significantly stepped up in terms of its product quality and technology, and is ready to face the inevitable competition that was supposed to come from the Harleys and Triumphs of the world. I'm not saying that the Harleys and Triumphs won't succeed, but I think this tailwind of demand that's there for higher end bikes will mean that there will be space for more than one. For a long time, it was iShare which had more than 90% market share in the 250cc plus segment. But I reckon that that segment will be the most attractive in terms of growth, albeit we'll also see some competition. We're quite comfortable with our position in iShare.
Eicher within the two-wheeler pack, betting on that entire luxury and premium end. But Pramod, what about the real estate pack? Any picks from that space?
We've historically hesitated to participate in real estate developers to play the real estate story. We played it through home building materials, where you do have some really fantastic business models which are not leveraged. At the same time, there is scope for building competitive advantage through brand and distribution. So we own, paints companies, adhesives companies, pipes, fittings. There are potentially good plays in tiles and sanitary ware and electricals as well. So our preference to play the real estate cycle is through building materials, and stay away from developers. Partly because of our philosophy of looking for very low leverage on the balance sheet in the business model, and hence the preference for building materials.
Pramod, great to have you on the show. Thanks as always for taking the time out.
Most welcome. Thank you.